Second part, we are going to run the semi-annual coupon bonds because corporate bonds usually they pay coupon semi-annual basis. This is the PINRA. In this site, we can get information about U.S. corporate bonds. I already find some specific pump, the Apple Incorporation. They have the bond information, the maturity date, and their price. As you can see, their bond type is US corporate, and they give a coupon, semi-annual basis. So now we learn how to calculate when the firm gives semi-annual coupon. So far, all of our bond is annual terms. Next, just convert to semi-annual terms. So semi-annual basis. It's quite simple. The payment occurs every 6 months. So the payments occur every 6 months. So the number of periods just multiply by 2, right? So 2n. And I per year, this is annual concept, so you should period rate. So divided by 2. And PV, the market value, it is okay, right? And face value, it is also okay. And payment, as I mentioned before, payments occur every 6 months, so you should divide by 2 from the annual coupon. Here is example. What is the value of 10-year 10% semi-annual coupon bonds if discount rate is 13%? So as we learned before, and just multiply 2, right? 10-year multiply by 2. And I per year, this number comes from here, right? RD divided by 2. And payments, this number is annual coupon. So we should divide by 2. And face value is same, right? And some students can suggest a question about this, the 6.5. Suppose when we draw a timeline for simply 0, 6 months, 1 year, we get 50-50, but it is different with this 0, 100, but the rate is 30%. In this case, 6.5%, 6.5%, because it ignores compounding. When we get 2 times the coupon, we can reinvest the money. So the EAR is more good to explain the annual rate. But there is a long history. It had not computation power long time ago. So for the simplicity, the bond traders use APR convention. So we usually use nominal rate, and we call that APR convention. So you simply calculate the period rate. It's another example. What is the yield to maturity over 10-year 10% semi-annual coupon bonds that sell for this money? In this case, we input the 4 keystroke and then get the number, the 6.5%. Is it yield to maturity of these bonds? No. because this is annual concept. So we should multiply by 2. That is yield to maturity. As I mentioned before, the I or RD interpreted required rate of return, right? So RD can be calculated by RRF, risk-free rate, default risk premium, and maturity risk premium. In this slide, we are going to check more deeply about default risk. If an issuer defaults, investors receive less than the promised return. So it influenced by the issuer's financial strength and the term of bond contract. Factors affecting the default risk, the financial performance, and bond contract provision. We checked more detail. The first one is financial performance, the debt ratio. Debt ratio can be calculated by total debt to total asset. When you see the balance sheet, the left hand side is total asset, and right hand side there are two parts, total debt and total equity. Why debt ratio affects default risk? A high debt ratio means the firm have more pressure from interest because it has more debt, right? So in this case, pressure means ability to pay back money. So if firm cannot pay back the money, firm can go to default, right? And the second one is TIE ratio. TIE stands for times interest earning. Earnings can be measured by EBIT. EBIT is accounting term. It stands for earnings before interest and tax. So it means how much pre-tax earnings firm generate. So TI ratio, it can be calculated by EBIT over interest. So in this case, the low TI ratio means the company earned not enough money cash for the interest, right? Second ratio is current ratio. Current ratio can be calculated by CA divided by CL. CA is current assets divided by current liability. The current means very short-term concept. So this ratio shows short-term liquidity of firm, especially cash categorized as a current asset. So the low current ratio means high default risk. Let me summarize these things. High debt ratio and low TIE ratio and low current ratio and unsecured debt and subordinated debt. This kind of performance, financial performance and contract provision can affect high default the risk. when the firm have high default risk, firm should give a compensation, should give compensation for the risk, right? So it has high required rate of return. So we can see high yield to maturity. In this slide shows the maturity risk. We already know the long-term debt is riskier than short-term debt. Now we learn more detail. Maturity risk we also call the price risk. The price risk is concerned that the rising RD, the called value of bond to par. So for example, this is the base, RD is 10%, but rising RD goes to 50%, the bond price goes down, right? From 1,000 to 957. Why the bond price goes down? Because RD here, right? RD use denominator, so denominator goes up, the value can decrease, right? We have two types of bonds here, 1-year bonds and 10-year bonds. 1-year bonds, we can say short-term bonds, and this is the long-term bonds. As you can see, short-term bonds fluctuate 4.4%, but long-term bonds, it fluctuates 25%, right? So the 10-year bond is more sensitive to interest rate change and hence has more maturity risk. So as I mentioned before, the price risk is key factor for the maturity risk. So in conclusion, the long-term debt has more price fluctuation. The price fluctuation key factor for the maturity risk. So long-term debt has more maturity risk. This slide shows other types of bonds. There are convertible bonds and bond with warrant. We simply say this is CB and this is BW. These two are a little bit similar. Yeah, both have rights to exchange or buy stock. They have some rights, and both are hybrid securities. It means now the current stock price let's say $10, but after some period the stock price goes up to let's say $50. In this case, the stock price is high enough the investor can decide to convert to what? From bond to stock. It's kind of option, so if investor don't want to convert, the investor don't have to do that. Bond with warrant is similar. The BW, let's have example to explain. The bond with warrant issue at $1,000. It has right to purchase 100 stocks of the company, and there is exercise price is 12, and current the stock price is same with this $10, and after some period the stock price is $15. They buy back the stock at $12 and sell at 50, right? Because in the market the stock price is traded in the $50, so the investor can have some benefit, right? But there is a different thing between them. The CB after converts, the bond is gone, so investor don't receive a coupon anymore. But bond with warrant, investor still receive the coupon after the option exercise. That is different thing. Why the investor buy this kind of hybrid security? Compared with stock, the advantage of bonds is less risky than stock. However, there is disadvantage of bonds. A bond cannot enjoy pump's upside potential. When pump invests really well, the stock price goes up, but bond investor cannot enjoy pump's good performance. These kinds of hybrid security can enjoy the upside potential. When stock price goes up, then CB investor and bond with warrant investor can buy or convert at low price. But generally, compared to regular bond, CB and BW has low coupon rate. That is for the right. It shows the callable bonds and puttable bonds. Callable bonds allows issuer to buy back the bond from the bondholder prior to maturity at a specified price. In this case, PUM have right to buy back the bond from bondholder, especially when the market interest goes down. PUM can refinancing with low market interest rate. So issuer buy back the bond from the bondholder prior to maturity at a specified price. The puttable bonds, the opposite case, a bond investor has the option. When the company issue bonds, they set the period which bondholders sell their bonds. The exercise price is usually par bond price. Generally, puttable bond price is higher than the regular bond price because issuing company also have the benefit. Issuer can receive the compensate for the risk of exercise put option. They can issue more higher price than regular price. So PUM can raise more money than regular bonds. The index bond coupon interest rate paid is based on benchmark index. Benchmark index market usually use the inflation rate. So the coupon rate can be calculated by some fixed number plus the benchmark index. So that is very safe financial asset. You don't have to worry about some part of maturity risk. When interest rates change with inflation, index bond coupon rates also change. So it gives a hedge for inflation. Until now, we run the other types of bonds, the convertible bonds, bond with warrants, and callable bonds and puttable bonds, and index bonds. This is the last slide of this chapter. Thank you.